Well, howdy, ladies and gentlemen. Welcome to economics class. This is the late show with Luke Fulcher. It's like 11:30, and I'm taping this because if procrastination was an Olympic event, I would be a gold medalist. And of course, congratulations as you're headed into the last week of your schooling here. Kind of hard to believe. But anyway, this is going to be the last lesson that's going to be on kind of like macroeconomics, about like how the economy works out there. The rest of the lessons, the rest of this week, we're going to have a couple that are like some personal financial management things that'll help you in your personal life. And then toward the end of the week, we'll have a lesson that's kind of Christian perspective on money, and then. I'm hoping to kind of get a video up too. It's just going to be some a little bit of some farewell advice for you as you're heading off into parts unknown here in the very near future. But and I haven't forgot. Sometime this week you will receive an email with the complete list of Mr. Fulcher's country song of the day, and it will be fun. So. So anyway, the kind of the last thing we'll talk about that's complicated and related to exterior economics is the idea of the Federal Reserve Bank and the idea of what they call monetary policy. Now fiscal policy, which we talked about last week, is like how the government tries to affect the economy by taxing and spending. Monetary policy is how the Federal Reserve tries to affect the economy by managing the amount of money that's in circulation, either to stop inflation or to cause it to happen in order for there to be more available money to affect the demand side of the equation, and to try to spur economic growth. So what is the Federal Reserve System? We've talked about it briefly, but the Federal Reserve System is the state bank, or the official bank of the United States government. It exists as kind of a weird structure. It's kind of half private, half public. It's not entirely accountable at a governmental level in the same way some government organizations are, but it also is very, very regulated and tied to the government in different ways as well. So we'll kind of look at how all that shakes out. So the Federal Reserve System, though, is the central bank of the United States. And if you, look at a dollar bill, the very first thing it'll say up top is Federal Reserve Note. So what exactly does a central bank do? There's a few things. One thing that they do is that they hold reserves. So, we've talked about how, when you deposit your money in the bank holds on to a certain percentage of the cash reserves and then puts the rest, into investment. The central bank holds the reserves. So the bank is going to lend a certain amount out and then put a certain amount into reserve, and the central bank in this case is going to hold those reserves. And so the Federal Reserve System actually kind of holds the bank holds the funds that are actually given to the local bank. They'll hold them on reserve for them. So they actually serve as the bank for the banks, as well as for the United States government. And the central banks also kind of work to assure economic stability, and they also take a part in lending money. But the Federal Reserve doesn't lend money to ordinary people. It doesn't lend money to businesses. They lend money to banks, and at times the government as well. We'll talk about that. But so they actually, if there was a situation where Bank of America or Wells Fargo, one of these big banks, actually needed money, for some reason, because they've got too much of it hung up or stuff like, where would they go for a loan? They would go to the Federal Reserve Board. So kind of some of the duties of the Fed: they provide banking services for private banks and for the national government. They accept and hold deposits in the form of cash reserves. They transfer funds between banks and government. they make loans, and they also are responsible at times for involvement in managing economic emergencies. So for instance, something like 9/11 goes down or something like that, they're pumping as much money into the banks as possible to make sure that the financial system doesn't collapse as a response to it. And the Federal Reserve is responsible. They're kind of responsible for how much money is in circulation. So they are the ones who actually distribute currency, which is coins and cash. They don't make it. It's made at the United States Mint and the Bureau of Printing and Engraving. But it is the Federal Reserve System that actually puts, the money into circulation. And they're actually the ones that are responsible to the extent that they can for managing like how much money is out there at a time. And we'll talk about in the lesson. We'll talk about how they do that. But first, how exactly is the Federal Reserve Bank structured? It's broken into 12 districts, and we are in the 5th district of the Federal Reserve, and so they've got 12 district banks underneath the National Bank. And so the Federal Reserve Board is a group of 7 people at a time. They're given 14-year terms, so that they're there for a long time. And the president appoints them. There's like a staggered departure. So every 2 years, a seat comes up on the board. Now remember, 14 years is a long time. So if I don't know if this is a year where someone's coming off the board or not, but if someone is coming off the board this year in 2020, it meant that they were appointed in 2006. So if someone's just leaving this year, they've been on there since when W was president. So, I mean, you serve a long time when you get named to the board. You've got your job for 14 years if you want it. If you quit early, the president will name a replacement. And the president also chooses the chairman of the Federal Reserve Board out of the group of 7 that are there. So if you're president, for 4 years, you only get to pick 2 of these people, and the rest of the other 5 of them will be from previous administrations. But you get to choose which of the 7 you're going to make the chairman. And I think the current chairman, I know it was a woman named Janet Yellen until I think just recently. I can't remember who the new person is. Was it Powell? Yeah, I think it's something Powell. But the chairman of the Federal Reserve Board, even though I can't think of his name right now, the most famous chairman of all time was Alan Greenspan, who was actually the chairman of the board for just about 20 years. I'm not sure how he got past the 14-year thing, but anyway, he was the most famous of them. He was given a lot of credit for the economic prosperity of the 90s and early 2000s, although his reputation suffered a little after the 2008 financial crash. Some people think he had done some things to help set that up, but up until then, he was kind of looked upon as like a godlike figure among economists and so on. But anyway, there's this famous clip. I can't remember if I've mentioned it in here or not. I know I mentioned it in one class where Norm Macdonald, the comedian, was doing some White House toast roast thing, and when President Clinton was president, and he got up and he made a joke about I'm here. It's a little intimidating making jokes in front of the most powerful man in the world, Alan Greenspan, and then the camera pans to Bill Clinton. Bill Clinton's rolling laughing because he knows it's true. The chairman of the Federal Reserve Board is actually one of the most powerful people in the world. Even if you don't know his name, billions of dollars hang on their decisions. So they're actually very, very vital people, some of the most powerful people in the world. And so basically, all nationally chartered banks are automatically members of the Federal Reserve System. State chartered banks may apply to join the Fed. In 2004, there were 2,000 national bank members, 900 state bank members, 37% of all commercial banks. So a little bit over 1 out of 3 banks that you would go do business with are connected to the Federal Reserve System in that way. Within the Federal Reserve System, they have something called the Federal Open Market Committee that makes decisions about the sale and purchase of federal government securities. There's 12 voting members in the FOMC, and we'll talk about the significance of that more in a second. What are the things that the Federal Reserve do? One thing that they do is the process of check clearing, which is used to be a bigger part of what they do than it is now, because people aren't using checks and stuff in quite the same way. But it's actually, if you look at the chart here on page 481, you see when you write someone a check, the whole time where you're waiting a few days for the check to clear, there's a reason for that, because there's actually quite a bit that goes into a check clearing. So they give an example on, in your book of a fella named Mike, lives in Illinois, and he buys a pack of guitar strings from a store in Oregon, maybe on over the internet or something like that. Well, no, it couldn't have been. So I guess he was traveling in Oregon at the time, but he lives in Illinois. So he writes a check to a guy named Gary for his guitar strings, right? And so Gary deposits the check at the bank. What happens next is that Gary's bank credits his account with $30 and then sends Mike's check to the Federal Reserve Bank of San Francisco, which is the Fed district that serves the city of Portland. Then the Federal Reserve Bank of San Francisco credits $30 to Gary's bank reserve account and then sends Mike's check to the Federal Reserve Bank of Chicago, which is the Fed district that served his city in Illinois. The Federal Reserve Bank of Chicago would then transfer $30 from its reserves to the San Francisco Fed District Bank and then sends Mike's check back to his personal bank in Evanston. Then Mike's bank transfers $30 from its reserve to the Federal Reserve Bank of Chicago, deducts $30 from Mike's account, and this transaction is reflected on Mike's next bank statement. So you never knew just how much nonsense goes on in between you writing the check and them getting the money, because it seems like it happens pretty quickly, but it's actually moving around all these banks that are involved in the writing of the check. So one thing they do is taking part in this kind of check clearing process. The second thing, and this is probably the thing that's most important, is lending money. So, and is in terms of the things that they provide for the banking system. A lot of times, the banks, like the commercial banks, will have budget shortfalls or something happen, and it then comes to the Federal Reserve System to actually lend them money in order to keep everything rolling. Banks a lot of times will wind up with cash flow things because they'll have a situation where they've lent out so much money and then they've got so much coming in, and they wind up sometimes being stuck betwixt and between. And when there are some of these crises, the Fed will provide loans to banks and may charge reduced interest rates. And of course, a bank has to have certain qualifications to get loans from the Fed. And then another thing is that they're involved in regulating and supervising banks and giving what they call bank exams, which are kind of audits of their practices. Now, what is perhaps a little bit more famous about the Fed also is the things that they do to serve the federal government. So the Federal Reserve System is the bank of the United States government. When you pay your taxes, the Federal Reserve System is the bank into which the government places them. And then when you draw Social Security or unemployment or anything that comes from the government, you are getting that money out of, or you're being given that money out of the Federal Reserve Bank. That's also the case with, if the Army has to buy a helicopter from Boeing, or if the IRS has to buy a pack of pencils. Any government expenditures come out of the Federal Reserve Bank, and all the government's money sits in the Federal Reserve. The Federal Reserve Bank buys and sells government securities, that is, bonds. So we talked about how when we talked about the national debt, we talked about the how does the government borrow money? It borrows money from bonds going up for sale. Well, it's the Federal Reserve that actually is the one that sells said bonds. Working in conjunction, I should say, with the Treasury Department. So the Treasury Department is involved in that process as well. And then one other thing is that they distribute currency, which is why if you look at a bill, it will say Federal Reserve Note at the top. And they are responsible for eventually replacing bills. The lifespan of the average paper bill is 2 to 5 years. As when money comes into the Federal Reserve System, if it's if the money is falling apart or whatever, it'll be like scrapped and replaced with a new, sometimes with like new bills from the Treasury, and this kind of keeps the money, the paper money, staying relatively fresh. So typically, a dollar bill is actually going to be destroyed after 5 years if it passes between enough people and it goes back into the hands of the Federal Reserve Bank somehow or another. So all right, so one of the things that they're responsible for doing is creating money. And when I say that, we don't mean the actual printing of bills, because that's done by the U.S. Mint. We don't mean the necessarily melting coins. That's done by the Mint and the Bureau of Engraving. What we mean is they allow money to enter into the system, and they do this by using the banking system. So American banks are what they call fractional reserve banks, meaning they have to keep a certain amount and then they can loan everything that's above that certain amount. And that amount that they have to keep is called the required reserve ratio, RRR, required reserve ratio. And the required reserve ratio, the RRR, say that 7 times fast and wear an eye patch and you'll feel like you're a pirate. The RRR, sorry, I should not be trying to teach class at midnight. That's my problem. Okay, so the Fed establishes the RRR, and what the RRR does, this is ridiculous, is it establishes the baseline in which the percentage of money that the bank has to keep on hand, and then everything above that they can go lend out to people and use for other things. So, and they manipulate the RRR in order to either limit or increase the amount of money that the bank has to lend based on the Federal Reserve kind of keeps track on, because they're all about, like, their mission is kind of to like smooth the business cycle. They don't want like massive growth in inflation, but they also want to have like kind of slow inflation because they still want productivity because they're concerned about unemployment and stuff like that. So they want economic growth, but they don't want it to come so fast that it causes excessive inflation. And so they're working to try to like mitigate the business cycle. That's kind of the goal that they're working toward. And so because of that, they try to manipulate how easy it is to get loans from the bank. So when they're in what they call an easy money phase, it's a lot easier to go to the bank and get money to start a business or buy a car or buy a house. When it's a hard money phase, the bank has less money to lend, so they get more selective or charge higher interest rate or charge different interest rates. So, so how does money creation work? So if you want to follow along, page 484 in your textbook. So the banking system creates money wherever banks receive deposits and make loans. So the level of the RRR determines how much money may be loaned and therefore how much money is created. So if you look at figure 16.5 there on page 484, it says at the top of the chart, so they've got an example of how this process would work at two different levels of RRR. And so at the top of the chart, at this point in time, the RRR is set at 20%. Okay, so if Bank A has $10,000 in deposits, it has to keep 20% or $2,000 on reserve. And let's say then that they lend the remaining $8,000 that's available to lend. They lend it to Keisha's Fitness Studio. So then Keisha goes and deposits it in Bank B. Well, Bank B has to keep 20% of the $8,000, which is $1,600, on reserve. But Bank B then lends the remaining $6,400 to Juan's computer repair. And then Juan deposits it in Bank C. At this point, the money supply has increased by $14,000, which is the total of the loans made. And that process could continue until there was nothing left to lend, because maybe, Juan is going to deposit it in Bank C, and they'll lend, they'll keep, 20% of the $6,400, and you can keep going on and on. And so what happens is each of these loans has put more money into circulation, has gotten it moving around, and put it out into the market. But if you look at the bottom of the chart, they have a situation where the Fed has cut the RRR to 10%, which is actually more realistic. In recent years, it's kind of hovered between 10 and 12. At least I think that's what I read in here a minute ago. I was having to refresh my memory on some of this stuff. When they do that, and the bank only has to keep 10% on a reserve, and they can loan 90, now you've created a situation where you have significantly increased the amount of money that is available to be loaned. And they have a formula called the deposit multiplier formula, which is 1 over RRR, and that demonstrates how much the money supply will increase after an initial cash deposit. So what are the factors that affect demand for money? One is the need to have cash on hand. There are certain situations where people want more cash than normal. Some of the recent madness may be an example of that. Natural disasters, Christmas time. There's a number of different times where people want more money than usual. And so when that happens, the feds oftentimes will put more money into the commercial bank, or lend money to the commercial banks or whatever, so that a lot more people are going to the ATM around Christmas because they're shopping a lot, and so the banks, if I don't know if you ever had the experience of when your ATM has run out of money, but it's irritating, and so banks don't like that. So sometimes they'll borrow money from the Fed for cash flow for things like that. Interest rates is another factor. When interest rates are high, individuals and businesses may place excess cash in stocks, bonds, and savings accounts, and that pulls the cash out of circulation, quits moving it around, and then that money moves from being part of the immediately accessible money supply, which if you remember from a previous lesson we call M1, and puts it into what they call M2, which is the immediate money supply plus the things that are not immediately accessible. But when interest rates are high, the demand for money is lower because there's less incentive for individuals and businesses to spend, and there's more incentive to save and earn interest. When interest rates are lower, more money is demanded because people have less incentive to save and more to spend, which is why a lot of times when you get into, if there's some signs of a recession coming, sometimes they'll cut interest rates in an attempt to discourage savings and encourage spending, because they'll think if more people have money to spend, it'll benefit the businesses. So the cost of consumer goods and services affects it, and then the level of income. The more money people have, the more they'll want access to cash in general. So this leads us to monetary policy, which is one of the most important functions of the Fed. And this is kind of the way that they play their role in kind of managing and smoothing the economic situation. So monetary policy is the Fed's actions that change the money supply in order to influence the economy. And there's a few different ways that they do that. So the first is what they call open market operations. That is the buying and selling of government bonds. So open market operations are the sales and purchase of marketable federal government securities. And this is what they do the most to affect the rate of money supply. So the Fed pays for bonds that it buys from commercial banks or the public by writing checks on itself. So in this case, the Fed is actually trying to take government bonds that have been sold to people or to commercial banks like Bank of America or Wells Fargo or whoever. They want to take them out of circulation by buying them. They had been involved probably in the selling them in the first place, so they now want to buy them back. And the reason that they would want to do that is that when the sellers of the bonds get the funds from the Fed, they then deposit them in banks. The banks can then lend their new excess reserves. So the banks have to hold the 10%, 20%, whatever the rate is, and then they can lend out the rest. When the Fed wants to contract the money supply, so if the Fed decides that they want to increase the money supply, they're going to start buying the bonds, and so when they buy the bonds, the people out in the ordinary folks out in the economy, the people that had previously had the bonds now have more cash that they can then go and put in the bank, which means that the banks actually have more money to loan out. When they want to contract it to prevent excessive inflation, what they'll do is they'll actually start selling instead. And when they sell bonds on the open market, the purchasers of the bonds transfer funds to the Fed to pay for the bonds, and then so they'll sell the bonds, and then when the Feds get their money, they'll sit on it instead of putting it back out in another bank where it can circulate. They'll stick it in reserve, and that money kind of disappears from circulation. Does that make sense? I love how I just have this instinct of asking, does that make sense? But you can't answer me because you're watching after the fact on a computer. You could ask questions, but I'm sure all of you are like, I have to understand every word of this lesson in my last week. Yeah, absolutely. So if they want to contract the money supply, they're going to sell bonds and then take the money they got from the sale and store it away. When they want to expand the money supply, they're going to buy bonds from people, knowing that the people that buy those bonds are then going to deposit them in commercial banks, which are then going to be able to lend that money out. The second thing that they can do is adjust the reserve requirement, that RRR that we had so much fun with a few minutes ago, because if they raise the RRR, the banks have to hold more in reserve, which means they have to decrease lending. That's going to contract the money supply to fight inflation. But if they want to stimulate growth, they'll lower the RRR, so the banks have to hold fewer reserves, which means they can loan more money out, which means that they can that with the increased lending, there's now more supply of money going around, and that's what they'll do if there's like a crisis of like they're trying to figure out how to fix like unemployment or something like that. Is we need more investment, we need people to expand operations, and so on. So that's what you do if you're trying to expand things. And then the third thing they can do is adjust the discount rate, which is the interest rate that the Fed charges when it lends money to other banks. And the discount rate affects the money supply because it sets the reserves that banks have available to lend. When the Fed increases the discount rate, banks tend to borrow less money from the Fed. They must then use their existing funds to meet their reserve requirements, and therefore they have less money to lend, and therefore that decreases the money supply. If they decide to lower the discount rate, banks would borrow more money from the Fed. They then would have more in reserve, and they'll have more money to lend. The money supply will go up. The Fed's actions also impact businesses and individuals who borrow, because there's something called the prime rate, which is the interest rate that banks charge their best customers. Interest rates for other borrowers tend to be 2 or 3 percentage points above prime. To make a profit on the loans that they make, banks need to charge higher rates than they pay to borrow. So when the discount rate increases, so does the prime rate. So in other words, the bank, if the Fed start charging more interest toward the banks, then the banks are going to start charging more interest to the guy that wants to get a home loan, or the guy that wants to get a business loan. So ultimately, the decisions of the Federal Reserve are going to trickle down to your personal economic decisions, because it'll make it a lot cheaper or more expensive to buy a home, buy a car, start a business, etc., based on where the interest rates are, and the interest rate at Wells Fargo or Bank of America or whatever are going to be in direct proportion to the interest rate that the Federal Reserve Bank is charging them on stuff. So I know that's a lot to throw at you. This is possibly the most complicated lesson we've had all year. So basically, though, there's 3 ways that the Fed has to expand the money supply and get more money moving if they want more money available to lend, and they want better circulation, and they want more opportunity for economic growth and dealing with unemployment and stuff like that. And so the 3 ways that they expand the money supply were to be buying bonds on the open market, lowering the RRR, or lowering the discount rate, or lowering interest rates. The 3 ways that they could contract the money supply in order to fight off excessive inflation would be to sell bonds on the open market, to raise the RRR, and to raise the discount rate, which would cause banks to borrow less. And so when you're trying to expand the money supply, that is expansionary policy or easy money policy. So when the Fed is in an easy money mood is the best time to get, for instance, a mortgage, because they've intentionally made it easier to borrow money than in normal circumstances. When they're in a tight money mood, banks are going to have to charge higher interest rates to you as an individual, because they're being charged higher rates by the Fed, and because with less money to loan out, they have to be more selective in who they loan the money to, and so they'll therefore will determine based that partially on who can pay those higher interest rates. So let's see. So Yeah. Now, one issue with all this stuff is it takes a little while for the trickle down to happen between when the change was made to the policy and when it actually has economic impact. And if they mistime that in terms of the business cycle, um, there can be bad consequences. If the Fed is actually doing a good job, they can kind of slow down the insanity of the business cycle and kind of smooth it out and avoid like a depression situation. But if they blow it, if they make big mistakes, they can help cause stuff. And there are certainly some economists who think that that they made mistakes to help lead to the Great Depression. There is a school of thought in economics called monetarism, which is most famously associated with Milton Friedman, who we talked about earlier in the year, who was one of the leading economists around the Reagan administration. And monetarism believes that the most important factor, the most important impact that government can have in affecting the economy is making sure that the money supply is stable. And most monitors think that you should be shooting for kind of a steady, 2 to 3% inflation. They think that if you get less than that or more than that, you start having. They think that really jarring differences in the money supply are the biggest cause of recessions and economic craziness. So that's monetarism, and that's associated with Milton Friedman. All right, guys. Well, you survived that one. I know that was a little bit of a harrowing lesson at times, but hopefully that makes a little bit of sense to you. It might help you get a little bit of a context of what people mean when they talk about interest rates are going down and what on or what all. So anyway, I will talk to you later on in this week. Y'all have yourselves a good day.